Welcome to Making Money. This is Matt McCall. It is Thursday and another big show coming your way. We're going to do something a little bit special. We're going to take a look at the charts. We're going to break down what's really going on with this market. We'll talk about what happened with the Fed yesterday, implications for that going forward. But again, we're going to concentrate on the charts today because to me, that's extremely important. It's going to tell a story that maybe we haven't talked about here yet, if ever. So we're going to get into that in one moment coming up on Making Money. Again, it's Matt McCall. Thanks for joining me. It is Thursday, January 27th. It's almost the end of the month. It's absolutely fantastic how things are flying by. However, the market hasn't been really cooperating with us so far this year. We had a crazy week. When I was back here Tuesday, the market was all over the place. We were able to close up on Monday after being down very big. We talked about that one-day turnaround. We didn't really get follow through on Tuesday. We had the markets come back down on Tuesday. Wednesday, we did have a little bit on the upside, but really kind of mixed because we had the Fed meeting end and we had our Fed chairman, Jerome Powell, come out. And he's basically alluding to the fact that the Fed's going to be hawkish, which means they're going to be a little more aggressive as far as raising interest rates. And now the market is actually pricing in, just a few months ago, they're pricing in 325 basis points, which is 0.25% interest rate hikes in 2022. The odds now are for 5. The next meeting is in March, and that's probably going to be the first time that they raise interest rates. Some are saying now they might do 50 basis points, so a 0.5% increase. So it's going to be pretty fascinating to see what happens with this market. All that being said, it's going to keep volatility extremely high because there's a lot of unknowns out there right now. Will it be 3? Will it be 4? Will it be 5? I still think 4 is very, very high probability. Could 5 happen? Yes, but I also think it's very data dependent, which means depending on how the data comes in the next few months throughout the rest of the year, that's going to dictate. If inflation somehow comes down quite a bit and gets in check, that's probably a good thing. If for some reason growth slows, that could be a concern and they aren't as aggressive in raising interest rates. If growth accelerates, maybe we do get to 5 and inflation doesn't come down. So there's a lot of data out there that will push that. The one good thing is the market's gotten hit into correction territory. And that's pricing in a lot of this volatility I'm talking about. It's pricing in the higher interest rates I just mentioned. So you're pricing a lot of this stuff already. It's not like we're just hearing about this today. So to me, that gives us limited downside. Even though things will be a lot of volatility, it might be a 10% rally followed by a 10% pullback and vice versa. I think we're going to see a lot of that this year. And I talked about that in my outlook for 2022. And I said, we'll probably have 2 corrections. We had one already. It's only January. I also said we're going to have a pretty volatile market because there's so many unknowns. There's the Fed, obviously, with interest rates. There is the pandemic. Will there be another variant? Whatever. Are they going to shut things down? Are we going to come roaring back open and everybody's flying again more than before? I don't know. It's very tough to really determine what's going to happen there. And there's one thing that investors hate more than anything, folks, and that's uncertainty. They'd rather know. If they said right now, Powell's going to raise interest rates 5 times in 2022, guaranteed, this is what's going to be said. We could price that into the market. Because you don't know, he may only end up having 3 interest rate hikes, either probably 4, but that's less than the 5. It should be better, quote unquote, for the markets. But because we don't know, it doesn't matter. We're gonna sell first, ask questions later, and look at worst case scenarios. That's just the way, unfortunately, we do it as investors. And that's why a lot of times you need to take the emotions out, which is why we're going to take a look at the charts here and show you exactly what's kind of going on behind the scenes. The first chart we're going to take a look at is the SPYs, SPY, and that's the S&P 500 ETF. Now, as you see in this chart, I've talked about this one a lot. We had this line I drew up here that was a support line. We hit a couple times, it broke down. Now we're coming down right here to another support level around 430, and we're holding it at that level right now. As long as we hold above that, things look pretty darn good. And you can see here the volatility that we've had the last couple of days. And as long as we hold above there, but again, that blue line right here, that is the 200-day moving average. That's another level that we need to keep an eye on. But again, around at 428 to 430, that is the level to watch. And what we're going to do is here, I kind of just have these random, but I have a bunch of sector ETFs. I think it's very important to take a look at the sectors and we can see what's going on. The second one we're going to take a look here is IAU, which is the iShares Gold Trust ETF. So basically that's the same as a GLD, it tracks the price of gold. And many of you know that I'm not a big fan of gold. So as you can see, in this chart, there's a reason, because it really has done nothing. And in times like this, where we do have inflation to highest level in decades, we have interest rates starting to go up, we should see gold really outperforming, greatly outperforming. And we're not. It's at the same level it's been for several months now. It's actually making lower highs and lower lows. It is kind of making a bit of a triangle here. So at some point, it's going to break up or down and run or drop back down to the low at 32. The next one here is related as well, the gold miners ETF. So with this one in the gold miners ETF, symbol GDX, you can see how it is been coming down, trying to form a bit of a base down here, but it hit a year low in October, and since that time just kind of going sideways. If I zoom out a little bit more, you see that it's not a horrible chart. If you go out a couple of years, had a huge rally in 2020, and then it came down consolidating. So it's really not that bad on a long term, sitting around that $30 level. But again, we've been in a distinct downturn here for a while, in a downtrend. So if this breaks below this 29 and change level, that's actually pretty ugly. That's really not good for the gold miners. And again, another one I'd stay away from. Now we'll take a look at a pretty decent looking chart. And this is the financials. And the reason the financials tend to do well in this type of environment is as interest rates go up, it's actually really good for the banks and for small regional banks because they lend money. A lot of them make a ton of their money by lending money. And when interest rates go up, they can charge a little more. But the percentage actually goes higher. You're charging more. Even though they're paying a little more to borrow it, the margins, the difference between what they pay to borrow and what they lend it to you at increases. So as that margin increases, they essentially make more money. It's pretty simple. And that's what XLF, which is a basket of large banks, JP Morgan, Bank of America, Goldman Sachs, you get it, Wells Fargo. That's why that hit an all-time high just about 3 or so weeks ago. But, we hit an all-time high, and look how quickly it pulled back. We pulled back over 10%. That's a very, very fast correction we had, but it's bounced. It's actually held up much better the last couple of days. I'm going to flip over to a chart real quick and kind of show you why I think it's held up so well. And this is the 10-year yield. And right now it's about 1.85%. It spiked yesterday after Powell came out. So that spiked up, and that's helping the financials. So that's one to keep an eye on. They're going to kind of move hand in hand. There's definitely a correlation between the two, and we'll probably continue to see that. This is the Global X Lithium ETF. And this is an interesting play because this is a play almost truly on electric vehicles, because the demand for batteries for electric vehicles is going to greatly outweigh the current demand or the previous demand that we had for lithium-ion batteries from just electronics, like my phone, my laptop, and a lot of things you have laying around the house. But the amount of lithium needed for obviously a much larger battery to power a vehicle, it creates a big demand issue. And on the other side, supply just hasn't really been there. So you can see this chart's pretty nice looking. It had a bit of a high here in January of last year, broke through a consolidate. Now we're pulling back to that previous high. The blue line's a 200-day moving average. You're sitting on a ton of support right now. This is the RSI down here, the white line down to around 16. So it's pretty oversold. Again, this doesn't matter unless it starts turning up, but I just like to show you that it is oversold. A bit of consolidation right here. So this is why I might want to keep an eye on, but this is going to be some lithium miners, lithium producers. It is an international play, so there's stocks from all over. A lot of Australian companies in there, some Chinese companies in there, U.S. based as well, Canadian. So that's one to keep an eye on, and it is an indirect play on electric vehicles. The next chart here is the Semiconductor ETF, VanEck Semiconductor ETF, symbol SMH. Again, a lot of these charts that have looked good look pretty similar, where it was at or near an all-time high in January and just plunged. Everything's just plunged recently, and back down to the blue line, the 200-day moving average. It's got a ton of price support at 250, but again, look how quickly it came down. And could it keep going all the way down here? It could. I don't know. But I will tell you, there's a lot of great semiconductors out there right now that are having record corporate profits that look really, really good, that if you're getting crushed with the index down about 10%, a lot of the individual stocks on 15, 20, 25%, believe it or not, losing a quarter of their value. So this is, again, another one I would like to keep an eye on, because the future of anything and everything deals with semiconductors, even electric vehicles. Think about how many. It's basically a computer on 4 wheels. How many semiconductors, how many sensors are needed for that? And especially when you get to autonomous vehicles that are connected, my goodness, it's going to be crazy. So we really want to look at that, at the semiconductors that are really focusing on the transportation aspects. I think that is really a great place to be. Next here is XLE, and that's the energy ETF. And you can see it here. where it's closing at yesterday. It is right near a multi-year high. Here's zooming out. It still has a long way to go when oil was really high back around 2013, 2014, but it's had a hell of a year. 2021 was one of the best years for the energy stocks I've seen in a long time, and it's actually continuing this year. It's one of the few sectors actually holding up. And that has to do obviously with the price of oil. So as the price of oil holds up, obviously it helps the margins for the energy companies. So yeah, I think it could continue for a little bit. It's also a bit of a hedge. Commodities can do well in this type of environment, inflationary times. I just don't see oil prices going that much higher. So that concerns me a little bit. And I think there is limited upside at this point, and much bigger downside. So when I look at the reward to risk, it doesn't jump out at me as a buying opportunity here. If you have some in your portfolio, I see nothing wrong with keeping it as a bit of a diversification. But again, because of where it's at now, I just don't see, I'm looking ahead, not back. And looking ahead, I don't see a lot of upside potential. Here's XLK. This is the Spider's technology ETF. And this is a basket of the large guys. So it's going to be Apple, Microsoft, Google, you name it. So it's the big names. And it's going to trade very similar to the QQQs, which is the NASDAQ 100, which is a very similar allocation to the technology ETF. But again, all-time high here at the end of December, and just absolutely crushed from 176 down to 146. I mean, that percentage-wise, folks, that's an enormous pullback. You know, that's well over 15%. So we're starting to bounce back. We're back near that 200-day moving average, that blue line. We do have some price support around here, as you can see, going back from 145 to 147. We held that, so I like that action. Huge volume in it. That means there's been a lot of people coming in, a lot of people getting out. It's been very high volatility going on, very high volume. So at this point right here, I think it's a nice hold and maybe even a little bit of an add down here. Again, nothing here is buy or sell recommendations. I don't have any exposure to any of these, but just so you know, like I do like it down here, especially if you like the big guys. I personally think the small cap technology is going to do much better in the next couple of years, but if you want some exposure to the big guys, it's a nice way to play it. Here he has XLY. This is consumer discretionary. So, you know, there's consumer discretionary means it's, there's that and there's consumer staples. So consumer discretionary are quote unquote the goods that are discretionary. You don't need it. It's not the toilet paper. It's not your soap. It's not your milk. It's things that you don't necessarily need. Nordstrom, for example, will be consumer discretionary. I mean, yeah, we need clothes, but it's going to be a little bit on the higher end, so it's going to be a discretionary play. These stocks they did pretty well last year, believe it or not. I'll zoom out here a little bit and show you long term. I mean, it's been really solid for several years now, but you can see up here it hit a high in November, but again, it got crushed this year. Just got absolutely demolished from about $215 a share down to about $175 at one point. We're at $181 right now. I just don't know. This is the type of ETF that I'm a bit cautious with. When it comes to this, there's a lot of retailers in there. I prefer to pick and choose my own retailers, and we've had a pretty good track record with that, and that's how I'd stick. I wouldn't necessarily look to do this because you get too much junk with everything else you're getting. Go back to another financial one here, and this is the S&P, Spider S&P Regional Banking ETF. So these are going to be smaller banks. You know, it's going to be the banks in your town on the corner, you know, not the national ones, not Wells Fargo, but the little guys. And this hit an all-time high in January. It's pulled back, holding up even better than XLF, which is the larger money center banks. And when it comes to higher interest rates, to me, this is one of the best hedges out there. I've said this for years. If you're looking at inflation, this is a great way to hedge against it. XLV, this is the healthcare ETF. You can see it hit a high there in December. It's pulled back, hitting a bit of support around 125 right here. Again, this is one that I like this, but a lot of big names in here. And you're going to have the Pfizers and all the other big names that I prefer personally, again, to kind of build my own little basket, as I call it, or my own little ETF. I don't necessarily need to look at getting into this big ETF because there's just too many names I don't want to own in there. And it's a little too diverse, but, you know, it's done well. And again, hit an all-time high in December and since pulled back, about another 10+%, moving into correction territory. We talked about this consumer discretionary a minute ago. How about consumer staples? You can see this chart's a little bit better. Let me just go back here. You see this chart, that's the staples. This is going to be your toilet paper, soap, all that kind of stuff. There's discretionary. It got hit much more. So we'll go back to the staples here. Staples look much better. I mean, it's holding right around the 50-day moving average, well above the 200. It's held that twice. A lot of price support, 73. This is a nice diversification for a portfolio, especially if you're pretty high in growth. Most of these will be value plays, and I don't know if value is going to last that much longer, this rally, this outperformance. But again, it's a nice way to diversify a portfolio with some staples. Utilities next, XLU. And utilities to me, again, this is a basket that I don't get very interested in. I would rather look at specific utilities that maybe have some exposure to clean energy. And some utilities have exposure to wind. Some utilities have exposure to solar. Some are more into the grid play, the future of the power grid. So you will have to be really specific when it comes to utilities. And again, it's a basket, a pretty large basket of utilities. So you're getting the overall sector here. But again, I would much rather pick individuals. So and this chart doesn't really blow me away by any means. ITB is a home construction ETF, so this is kind of a gauge as far as the stocks that are in companies that are involved with building homes. And you can see it had a nice breakout here in December and kind of tried to follow through the first couple of days of January and then just got crushed. I mean, it got smacked around again, another big pullback. Huge support at 65, so it may come down and hold that. I look around, looking for a house right now in South Florida, it's nearly impossible. And there's houses going up everywhere too, a lot of new homes. I looked at houses in Nashville, same thing, inventory's low, new homes, really anywhere you look. Every region is a little bit different, but what this comes down to me is the fact that interest rates are still low. They're going to go up, but it's mortgage rates, which are tied to interest rates, will remain historically low, which means money's still cheap to borrow. We have a millennial class that now is getting to a point where they're not peak earning, but they're getting at a level where they're earning more. Mine's Gen X. We're getting closer to that peak earning. And, maybe kids going to college, you're buying different homes, or maybe you want to upgrade to that second home. So there's a demand out there right now as family formation really increases in millennials. Gen X start to make more money. And take away the pandemic, essentially people are living longer every year. And I think that's going to continue. And there's just not enough inventory. That's the problem. It comes down to there's not enough homes, and you keep building. So I do like this ETF, especially on this pullback here. This is the industrial sector. It's exactly what it sounds like. It's industries, industrials that, XLI is a symbol. It's just going to be, manufacturing, that type of stuff. Probably a lot of companies you may have heard of, but probably you almost consider them boring, more value plays. But it's been holding up well. It's been going sideways, and all things considered in the market, it's actually holding up quite well. It doesn't really do much for me. Again, I'd rather look at kind of new age, not looking backwards. FDN, this is very similar to the other technology ETF. This is the First Trust Dow Jones Internet Index, but it's gotten smoked, folks. I mean, you look up here, it's right at an all-time high here in November at around 250, and then we hit the low just the other day at 180, which if we do percentages, that's down about 28%. I mean, that's a bear market's 20%, 28%. I mean, that just got absolutely crushed. And if you take a look at a longer-term chart here on FDN, you can see, it's had some other pullbacks along the way that are similar, similar magnitude. And if it can hold here, it might be a great buy, but boy, oh boy, it's gotten smacked around. I will tell you that. The next here is the Natural Resources ETF, and this is IGE. You can see how well this is done. It's pretty heavily invested in energy, oil and gas stocks, so that's what's held it up here, but it also has some exposure to even coal. It has a little bit of natural resources all over the place, but it has some pretty high exposure to oil and gas and energy, so that's why that's done well. We've talked about that already. XLB is the materials ETF, and this is going to be a potential winner if they ever get an infrastructure bill passed, because with infrastructure, obviously we need materials to build roads and bridges and outfit buildings and etc. So this is one that could play off pretty well in this pullback. It did hit an all-time high here right in the beginning of January, and since pulled back to support. So what I'm liking about a lot of these charts is the fact that a lot of them were at or near highs recently, and a lot of them are at or near very important support levels now. The caveat is if it doesn't hold these support levels and breaks down, it's probably not good, but if it holds it, that's actually a really good sign. Next is the NASDAQ Biotech ETF. I really thought 2022, or I should say, I still think 2022 is going to be a great year for biotech. We're just starting on a really, really rough note here. And this is a basket of stocks. This is a longer term chart. You can see here, this is going back to 2020. If I zoom in and look at a little bit shorter term, or actually, I'm going to zoom out a little bit longer term, sorry. You can see the pullback that we've had. But I've talked about this a few weeks ago, that when it comes to the biotech sector, every once in a while, every few years, it has a double-digit down year, which it had a pretty ugly year last year, so it's down. And it's typically followed by a big up year. Well, I still think it's possible, and I think, going into the year with the ETF around 150, and now it's at 127 and change, it's a great buy down here. Just to get back to 150, it's got to go about 20%, give or take. So I think there really is some great opportunity in biotechs. And we've had this risk off trade on. So that means people are selling out anything they perceive as risky. And biotechs are perceived as risky. The other issue is a lot of biotechs have to borrow money because they spend a ton of money to eventually, hopefully, get a drug approved. Well, the problem with that is you're borrowing at what the interest rates are. So if interest rates go up and you don't have a lot of good cash sitting on sidelines, but you still need 7 times that cash to achieve any goal of FDA approval, if it's possible, it means you're being borrowing money next couple of years, which means you're borrowing money at a higher price, which means that people are a little more selective in who they lend money to, which could hurt some smaller biotechs that don't have a good product or a good management or don't have a lot of cash on hand. So you have to be, again, really specific when it comes to biotechs, and which is why I wouldn't buy an index. I'd look at individual companies. This is one I've talked about before. This is iShares S&P Global Timber and Forestry ETF, symbols wood. And you can see it's pulled back, but this is a really nice hedge against inflation. And again, I think it's a good spot to park some money. This is the most exciting chart by any means, but it's held up pretty well. And I think that you will see some nice upside potential, even though inflation will probably start ticking down during this year, probably quite dramatically tick down by the end of the year. But yeah, I would keep an eye on it. And I think it's a nice little diversification tool. Here's XRT, the S&P Retail ETF. You can see it broke out in November, but again, getting crushed here as of late. I don't like the breakdown on this. Again, retail to me is so company specific, so trend specific, so fad specific that I would stay away from it and look for your own retailers. Here's PHO. This is the water ETF, and this is one that I've liked for a very, very long time. We could zoom out and show you how long it's been around here. And it's been a really nice investment. Not huge, but it's been a very nice investment. I mean, heck, I mentioned this back in my book, The Next Great Bull Market, back here, that came out in 2009, right down there. And so it's done very well since then, obviously. But I always think water is just a great investment. We need more of it. We have issues with trying to get it, especially out in California and certain areas where it's super dry. Hit an all-time high, again, pulled back quite a bit. A lot of this is water utilities. So again, I'm not a huge fan of the utilities right here. The other thing is with utilities, they can get hurt when interest rates go up, and actually anything that pays a dividend. As interest rates go up, it makes their dividend less attractive because the government's paying higher. So the one coming from a company, which is a little more risky, perceived as risky, is not as attractive. So people sell off stocks that pay dividends. Next is the communications ETF, IYZ, Dow Jones US Communications ETF. Really choppy chart, and there's a lot of big names in here, like the AT&Ts and stuff of the world. I just stay away from it. Now we have the REIT ETF, iShares REIT ETF, which hit a new all-time high here at the end of December, again, pulled back. But again, this could be getting hit for interest rates going higher because big reason people buy REITs is for the income. And as the income, the dividend percentage is less attractive, people will sell out of it. Second last one here, we got the IYT, the transportation index. It tracks the Dow Jones Transportation Index. It's got 20 stocks in it. And it's got some airlines, it's got some trucking, it's got some logistics, it's got like UPS, FedEx. This is kind of a play on a turnaround in the grand reopening. So I do think things will turn around. This could break through 280. It's also been hit a little bit because of higher fuel prices. So the fuel prices come down, we do reopen. This could be really a nice run on this one. And the last one here is a pharmaceutical ETF. So IHE it is. This is similar to what I talked about healthcare. I'd rather look at my own. It's the same thing in biotech, healthcare, pharmaceuticals. Choppy chart. I'd rather look at building my own portfolio versus doing this. So let me just go back real quick to the S&P 500. And again, we're at a pretty important level here. We want to watch this 427 to 430 area. Make sure it holds there on a closing basis, and if it does, that continues to build our base down here, which is a good sign. But we'll see. I'm doing this before the market opens. Market's about to open in a few minutes. The S&P is up about 1% pre-market, so we're getting a bit of a bounce after yesterday's midday sell-off. So we'll keep an eye on this. But again, I'll be back next Tuesday, next Thursday, next Tuesday, next Thursday. Keep going, and anything crazy comes up, I'll do a special one. But again, thanks everybody for watching. And remember, these charts are very important because it tells a true story. So I hope this helped. Let me know, comment below if you like. If I do charts every once in a while, we can start doing individual stocks as well. But again, thank you so much for watching. Hope you have a wonderful day and a wonderful weekend. I'm Matt McCall, and that's been Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.